Hi, hello everyone. So let's start discussion on today's a very important topic for the interest rate risks in the banking book. How that will measure and manage by the development financial institution like NaBFID. So if it is get impacted or what are the changes while we are changing the 200 basis point shocks. Basically 200 basis point shocks means 2% change in the shocks. So let's start discussion on this video, guys. Before moving to the video, I would like to request you, if you are new to my channel, so please do like and subscribe my channel. So I am will help you to prepare for the big four organization or the development financial institutions role or the quant analyst role or the business analyst role or the quality analyst role or the quantitative analyst role. So there I will definitely help you to get that opportunity, and I'm continuously pasting videos on my channel related to that. So let's start discussion on the points what we are going to discuss. So let's on the first slide we are going to discuss the what is and the internal rate risks in the banking book and why it's matter for the development financial institutions. So the IRB is the current and prospective risks to a bank capital and earning arising from adverse interest rate movement affecting non-traded interest rate sensitive and liability. It is crucial risk management pillars focusing on protecting earning net interest income and economic value of equity. So the bank has invested the bank has the core business of bank is to take the customers saving in the form of the current account or the saving account. It's we call the casa or the deposit or the recurring deposit, DP and RD, and that will lend to the another customer in the form of loans, which is the asset for the banks, and your the deposits are liabilities for the bank. So that will lend to the other customers in the form of loan. Okay. But if the suddenly change in the interest rate for the that bank, so it will be impacted on the banking book. So that's why the bank will measure or do the analysis on the interest rate risks on the banking book, and the economic value of the equity, how much the equity bank have in their hands today, what are the economic value of that funds or that equity in the future. So that will be part of the interest rate in the banking book. So there are the three main interest rate risks in banking book. First one is a gap risks, basis risks, and the operational risks, option risks. So the NAFAT exposure and the examples we're going to discuss each risk wise. So the gap risks, basically gap risks is asset liability repricing mismatch. So when we are have the long term assets, long term loan, and the liability are the short term like the bonds, the infrastructure projects where the NAFAD is invested for the 20-year, 25-year or 30 years, but it reissue bonds for just only 10-year or the 15-year. So there is a huge gap between the asset and liability and the bond issuance, the bond market. The borrowers, the bond borrowers, they need to pay their the principal and the interest rate at the time of maturity, but the duration of that bond, they need to pay the interest rate. So that's the liability for the NAFAD, and asset is the infrastructure loan. So there is a mismatch between that. Okay, that need to be managed by the NAFID. And let's consider the one of the example, 20-year loan funded by 10-year bond plus 3 years bank loan. So if suppose the 20-year loan with 2000 crore, so it's will be funded by 10-year bond with the 15,000 crore to issue the bond and raise the money 15,000 crore and then fund that infrastructure project. But the 3 years bank loan also 500,000 crore will be the bank loan. So that will manage for the 3 years. So bank need after 3 years, the NAFAD need to pay that the loan to the liability to the bank. So that need to manage there in the gap risk. Then the basic risk, different reference rates. So there is a different rated on the different type, like assets like the GSEC link security, liabilities treasury bill, or the MCLR link, or these are the different liabilities, so that need to be managed in the basic risk. And then the option risk, prepayment, embedded option, prepayment, someone do the prepayment and the embedded option. Then infra is a special purpose vehicle, refinancing loan, callable bond issue. So these are the risks, the internal interest rate risks in the banking book. These are the interest rate risks in the banking book. So let's move on the next slide, which is a most important, guys, and it should be, you should be aware that side. If the interviewer will ask you what are the factors impacted on the interest rate banking book, or what is the interest rate banking book, you should explain these things. So the parameters we consider, and change in economic value of equity, and the change in the net interest income. So first one is horizon. Will define the change in the income of equity is a long term and full life for the bank balance sheet statement, or BS. So the it and the change in the the economic value of equity is the whole life, or it is in the long duration we calculated. But in case of the change in net interest income, it is a short term, and we calculated it for the next 12 months. What are the impact on the change in the interest rate on the net interest income of that the NABFID or the development financial institution. Then the method to calculate the change in economic value of equity, or to calculate the net interest income. So NPV of all cash flows, base versus shock curve. So we calculated the NPV of all the cash flows that comes in the predicted, and what they we do the base versus the shock curve. What are the 200 basis point shock, or the operation and maintenance cost increase, the engineering procurement and construction cost increasing, the sponsor related fields is increasing. So that's the shock we consider, has RBI defined the different risk tests. And then the change in the interest rate income is a repricing gap into risk shock, and the time, how time that risk will be there. So that we do there. Then the risk capture. So the change in economic value of equity, we capture the risks like risk capital, or the economic value from maturity mismatch. So what are the different asset mature sometime, and the liability mature sometime, so that's a maturity mismatch. So we calculate the economic value of from that maturity mismatch. And then change in the interest rate income, we do the risks at earning from repricing the mismatch. So what the earning, what are the profit that generated by the development financial institution from the risks earning, and from the repricing mismatch with the difference. So the RBI threshold. So economic value of equity should be less than or equal to 15% of tier 1 for 200 basis point shock. If there is the positive or negative impact of the 200 basis point, so it will be the tier 1 and greater than the 15%. And then the change in the interest rate income has no limit, and internal asset liability committee trigger the set. How, when they are trigger, how that will be happen, so that will be done by the ALCO committee, internal liability management committee. Okay, then NaFAD use. So why the NaFAD use? For the change in economic value of equity and change in the interest rate income. So the strategic funding and the hedging decision. So bank will take on the basis of change in economic equity. So take and strategic funding and the hedging decisions, how they hedge. And then technical asset liability management, quarterly budgeting. So that thing the bank will keep in mind. So let's move on the development financial institution case study, where we are going to discuss the balance sheet setup and understand what are the asset and liabilities in their balance sheet, and then repricing tenure and how that will be impacted, and the rate of the balance sheet setup. So let's first discuss on the asset side, and then we will move on the liability side. So assets for the banks are the loans which will they provided the port construction, road construction, or the airport constructions, or the manufacturing unit for the the solar energy, wind energy. So 20-year infra loan, they funded by the 60,000 crore with 5 years repricing, and the rate is a fixed 7%. So that's the 7% risk, and it might be changes when the repricing will happen. Then the 5 years GSEC, 20 years, the crore they need to raise from that, and they invested in the 20-year GSEC and 5 year fixed with 7% rate of interest. And the 3 months treasury bill, 10,000 crore, they will invested, and then the 0.2% float, and it's the rate will be the market dependent, and the asset is total for the 9,000 crore. Okay, so that's the asset side. Let's discuss on the liability side, where the bank need to pay the principal and the interest rate, and the asset side where the bank receive the principal and the interest rate what they decide. So it will define on the fixed rate of interest, floating rate of interest, accordingly it will work. So let's discuss on the 10-year bond. So the 10-year bond, they will the issue the bond from the market with 40,000 crore, and it is under 10-year fixed bond, and they pay for that 7.5% rate of interest. So can at the maturity they will pay for the entire 40,000 crore, and the rate of interest of that year 7.5%. And at that, the duration of 10 year for the first year to 9 year, they will pay the 7% of that 40,000 crore as a rate of interest of 7%. And then the 3 years bank loan for the 30,000 crore, it is on the floating. It will be the T bill plus 100 basis points. So it's a rate will depend on the whatever the T bills rate of interest in the market plus 100 basis point. And then 1 year commercial paper. So the NaBFID will issue the 1 year commercial paper with collect the 10,000 crore, and 1 year fixed, and the 6.8% they will pay for that. And then equity 10,000 crore is the equity that will raise by the NaBFID or the development financial institution. So let's move on the very important topic, where we are going to discuss on the calculation of change in the net interest income and the change in the economic value of equity for 200 basis point shock. So if there is a 200 basis point change, so let's discuss on the net interest income for 12 months earning impact. So what are the impact on the 12 months earning? So let's discuss on the bucket gap net interest income, and then the interpretation of this example. So the bucket, the is they will raise the fund in the form of 0 to 12 months for the RSW of RS 10,000 and RLS for the 40,000. So gap is the 10,000 minus 40,000. Asset minus liability is their gap. So minus 30,000 crore liability sensitive. So they have the liability of minus 30,000 crore that need to be filled by the development financial institution or the NaBFID. So then the net interest income is the minus 30,000 with 2%, and the 1% it will be the uh, 600 crore. And then interpretation, if the rate raise 200 basis point today, the development loss will be the 6,000 crore net interest income in the liability repricing faster. So if they this is a risk scenario for the development financial institution. If the rate interest is increasing, they will start losing the 6,000 crore. If 100 basis point it will increases, then 3,000 crore net they will lose, and they need to manage and use different hedging techniques, or different repricing techniques, or the use the different interest rate swaps to hedge that thing and to manage this kind of risks. Then the economic value of equity, where the capital impact we are going to calculate. So asset duration, 20 years loan, the approximately 10-year bond like GSEC for the 4.3 years, and weighted for the duration asset is equal to 8.7 years. And the liability duration is a 10-year bond for the approximately 7, and bank loan for the duration of 10.7 years. So weighted the duration liability is 4.8 years. So the duration gap is nothing but the duration of assets minus the liability divided by assets into the duration of liability. So they that will be put in that formula of duration gap and calculate the minus 7.9 20 crore. So where's the RBI limit, it will be cross, it's a 79.2%, and it is a red flag. So bank need to take an appropriate actions on that, or immediate update to the RBI or the ALCO committee or the senior management risk management committee should take an appropriate action. So that need to be calculated here. So let's move on the like slide, and which is an the important slide guys for the implication and mitigation for the development financial institution on the ALCO committee. So where we are going to discuss on the risk signals, ALCO implications and mitigation and tool for the NABARD. So the national institute net interest income minus 600 crore is the earning volatility nil target mix, and there is the mitigation tool for that to increase the floating rate asset and the interest rate swap for pay the fix and receive the float to hedge that thing. So you need to do the pay fix and the floating float the roads, and in and then the economic value of equity, change in economic value of equity is equal to 79% of tier 1 breaches of RBI 50% limit and capital erosion. So where we do the extend the liability duration, issue the 15 to 20-year bond and asset swaps, and the risk basis. So T bills versus G6 spread. So use a basics swap and match the benchmark. So that's thing will done in the interest rate income, interest rate risks in the banking book, and the economic value of equity and the net interest income. So that we'll calculate in this way. So once again, thank you so much guys for attending this interesting seminar. So please do like and subscribe my channel, so that will motivate me to create and more such video guides. Once again, thank you so much guys for attending this interesting seminar.